India's market cap-to-GDP ratio is at an all-time high, second only to the US. Should you be worried? Amid the ongoing rally in the domestic equity market, the country's market cap has reached 120% of GDP, compared with the 10-year average of around 87%. The ratio is used to measure if a market is undervalued or overvalued compared to a historical average. The ratio for other major markets like the US, Japan and China stands at around 155%, 103% and 81% respectively. The combined market valuation of BSE-listed firms stood at Rs 369.33 lakh crore on January 5th, up 31% against Rs 281.95 lakh crore on January 5th, 2022. Is the market set to witness some correction considering the current cap to GDP ratio? But what does this mean? Kranthi Bathini, Director of Equity Strategy, Wealth Mills Securities, said, "Given the kind of high-growth prospects the Indian economy is exhibiting and due the prospects of sustainable growth on longer term, coupled with high visibility of corporate earnings, rising cap to GDP is not an alarming situation." On the other hand, Abhishek Basu Malik, Chief Equity Advisor, Intelsense Capital, said, "Market cap to GDP is a metric which needs to be observed over longer timeframes." Indian markets have been doing well, and additionally, we have seen a number of companies list through IPOs, increasing the listed market cap. Overall, it would not hurt the market. This may take out some froth from the markets, he said. According to Nirmal Bang Securities earnings, growth has broadly tracked nominal GDP growth, although rising corporate profitability, supported by margin expansion, has led to earnings growth outperforming nominal GDP growth in recent years. While we expect the rise in corporate profitability to sustain, consensus estimates for earnings growth at over 35% seem extremely optimistic, assuming nominal GDP growth of around 10%, the brokerage said. The brokerage further added that domestically, the risk-reward seems more favorable for large caps compared with small and mid-caps. However, the key risks are excessive liquidity, tightening both globally as well as domestically. Other risks include escalating geopolitical tensions and domestic election risks. While sharing key themes and stocks for 2024, Nirmal Bang Securities added that it would remain focused on domestic plays till the rate cut cycle starts. Themes such as blurring lines between urban and rural and the rise of Tier 2 and Tier 3 cities, financialization of savings and consumerization of debt, private capex recovery and the greening of manufacturing, rise in global defense spending and India gaining a foothold in global value chains supported by tailwinds such as China +1 are the key themes for the ongoing year. Stocks such as IndusInd Bank, Federal Bank, Shriram Finance, SBI Life, Maruti Suzuki, Ashok Leyland, GSPL, Ambuja Cements, Triveni Turbine and Blue Star are among the top stock ideas for 2024. Firstly, let's unravel the mystery behind the term market cap to GDP ratio. It sounds like a mouthful, but it's just a simple way to gauge the overall value of a country's publicly traded companies in relation to its economy. Let's break it down. Market capitalization, or market cap for short, is the total market value of a company's outstanding shares of stock. It's calculated by multiplying a company's shares outstanding by the current market price of one share. If a company has 1 million shares outstanding and the current market price of each share is $20, then the company's market cap is $20 million. The GDP, or gross domestic product, is the total value of all goods and services produced by a country in a year. It's a measure of a country's economic output. So the market cap to GDP ratio is simply the total value of all publicly traded stocks in a country divided by that country's GDP. It's a measure of the total value of all companies trading on the stock market compared to the value of the entire economy. Why is this ratio important, you ask? Well, it's a key indicator of whether the stock market is overvalued or undervalued compared to the overall economy. If the ratio is more than 100%, it could suggest that the market is overvalued and a correction might be due. On the other hand, if it's less than 100%, it could indicate that the market is undervalued. Think of it like comparing the price of an apple to the price of an entire fruit basket. If the price of the apple is more than the price of the whole fruit basket, you'd probably think the apple is overpriced. The same principle applies to the market cap to GDP ratio. With this understanding, we can now explore why this ratio is at an all-time high and what it means for investors. The market cap to GDP ratio is at an all-time high. But what does this actually mean? Let's take a look at the current scenario to understand this better. India's market cap to GDP ratio has been on a steady rise in recent years. This is driven by a combination of factors, each contributing to the growing divergence between the value of the country's stock market and its overall economic output. Firstly, India's economy has been expanding at a robust pace, fueling business growth and driving up stock prices. Global investors are bullish on India's prospects, which has resulted in surges in foreign direct investments. Secondly, the global economic environment has also played a significant role. The unprecedented stimulus measures worldwide have led to an influx of liquidity, which has found its way into emerging markets like India. This global liquidity has boosted stock valuations, leading to an increase in the market cap to GDP ratio. Thirdly, the government's pro-market policies have played a crucial role. Policies such as the easing of foreign direct investment norms, corporate tax cuts, and initiatives to boost manufacturing have all contributed to an optimistic business environment, which in turn has boosted the market cap. Now, let's put things into perspective by comparing the current ratio with historical data. The market cap to GDP ratio has exceeded 100%, a level last seen in the year 2007. This suggests that the stock market may be overvalued compared to the size of the economy. However, it's essential to note that the ratio alone doesn't necessarily signal an impending market crash. Other factors such as interest rates, inflation, and earnings growth also play a significant role in determining the direction of the market. So, with these factors in mind, we find ourselves staring at a market cap to GDP ratio that's at an all-time high. It's a figure that's intriguing, perplexing, and perhaps a little intimidating. Now that we know why the ratio is high, the question remains: should investors be worried? Let's explore this in the next segment. The high market cap to GDP ratio, a cause for concern or an opportunity for investors? This is the question that many of you might be pondering, so let's delve right in. A high market cap to GDP ratio can indicate that the stock market is overvalued. The higher the ratio, the more expensive the market. This could potentially signal a market bubble, and, as history has shown us, bubbles eventually burst. For investors, this could mean a significant loss of capital if the market were to correct itself. It's important to remember, however, that this ratio is merely one of many indicators. It doesn't necessarily mean a market crash is imminent. Some market observers argue that a high ratio can also reflect the market's optimism about future economic growth. In India's case, the high ratio might be signaling that investors are confident in the country's economic prospects. The economy is expected to grow at a robust pace over the next few years, backed by strong fundamentals such as a young population, increasing digitization, and government reforms. So, what does this mean for investors? Well, it means that it's crucial to tread carefully. Sure, the high ratio could indicate overvaluation, but it could also be a sign of investor confidence in India's future growth. It's key to balance optimism with caution. Diversifying your investment portfolio and not putting all your eggs in one basket can be a good strategy in such scenarios. Investors should also keep an eye on other economic indicators and not base their decisions solely on the market cap to GDP ratio. Monitoring trends in GDP growth, inflation, interest rates, and other economic indicators can provide a more comprehensive view of the market's health. Finally, remember to consider your own investment goals and risk tolerance. Every investor is unique, and what works for one may not work for another. While the high market cap to GDP ratio can seem alarming, it's crucial for investors to look at the bigger picture. So whether you see this as a red flag or a green light, make sure you're making informed decisions based on a holistic understanding of the market. So, what have we learned about the market cap to GDP ratio and its impact on investors? In essence, we've discovered that this ratio, while a bit complex, provides valuable insights into the economy's overall health. When it's high, as it is in India currently, the market could be overvalued, indicating a potential correction in the future. But it's crucial to remember that it's just one piece of the financial puzzle. We've also underscored the fact that India's market cap-to-GDP ratio is second only to the United States, a testament to the country's robust economic growth and vibrant markets. But as an investor, you should not let this single metric dictate your investment decisions. The key is to use it as a tool, along with other factors, to make well-rounded, informed choices. Stay curious, keep learning, and always do your homework before investing. Remember, informed investing is smart investing. Keep an eye on the market cap-to-GDP ratio, but don't forget to consider other important factors as well.